Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Private Equity Investments, a modern investor's guide. Ever wondered how some investors seem to find the golden goose in the financial market? Private equity might just be the answer. This investment strategy, which involves buying shares in private companies or taking a company private, has been reshaping the investment landscape. For those with money to invest, private equity offers a way to be part of a business's journey, from growth to profit. But why does private equity capture investors' attention? At its core, it's about identifying potential and fueling it with expertise and capital. Whether you're an experienced investor or a curious newcomer, understanding private equity can open doors to unique financial opportunities. Here, we'll break down the essentials of private equity investments and explore why they continue to attract savvy investors across the globe. Get ready to discover the ins and outs of this intriguing investment option. What is private equity? Private equity is a type of investment that involves putting money into private companies, not those listed on the stock exchange. Unlike public equity, where investors can buy shares of a company through markets like the NYSE or NASDAQ, private equity deals are conducted away from public markets. Think of it as investing in a startup or a struggling company that needs a financial boost to reach its potential. Private equity can offer significant rewards, often outperforming public stocks, but it comes with its own set of challenges and risks. Key characteristics of private equity. Private equity investments have some unique features that set them apart from other types of investments. Here are the main characteristics you should know. Illiquidity. Private equity investments aren't as easy to sell as stocks on the public market. You might have to hold on to them for years before seeing a return. Long-term investment horizon. These investments often require a long-term commitment. Investors are usually looking at a period of about 5 to 10 years before they can expect to realize their gains. Active management. Unlike public stocks where your influence is minimal, private equity investors often take an active role in managing the companies they invest in, helping steer business decisions to improve performance. Think of private equity like planting a tree. You won't see a towering oak overnight. It takes time, care, and a lot of patience before you can enjoy the shade. Types of private equity investments. Private equity isn't a one-size-fits-all kind of investment. Let's break down the main types of private equity investments. Venture capital. This involves investing in startups or young companies that have the potential for rapid growth. Venture capital is like being a shark on Shark Tank, providing the funds and support to turn ideas into successful businesses. Growth equity. Here, investors target established companies looking to expand or restructure. It's less risky than venture capital as these businesses are already generating revenue. Buyouts. This involves taking control of an existing company. Investors buy most or all of the company's shares to gain control. It's like flipping a house, fixing it up, and selling it for profit. Distressed investments. Investors buy troubled companies or their debts. The goal is to turn them around, much like a turnaround specialist tasked with saving a sinking ship. Each type of private equity has its risks and rewards, catering to different investment strategies and goals. Whether you're the adventurous type or more of a cautious investor, there's a form of private equity that might suit your style. The private equity investment process. Understanding the private equity investment process can feel like peeling back the layers of a mystery. This process is a blend of strategy and skill, where firms strive to make the best investments that will yield substantial returns. Let's break it down into digestible chunks so you can grasp the essentials without getting bogged down in complexity. Sourcing investment opportunities. Imagine being on a treasure hunt. For private equity firms, the first step is to spot the gold. Sourcing investment opportunities means identifying businesses that have potential for growth and profit. It's about being on the lookout for diamonds in the rough. Private equity firms often find these opportunities through networking. Building relationships with industry insiders opens doors. Firms stay connected with investment bankers, lawyers, and consultants who might know a company in need of investment. Market research. Scrutinizing market trends and economic conditions helps firms pinpoint industries ready to boom. Industry conferences. Attending these events is like fishing in a stocked pond. Firms meet business leaders and entrepreneurs showcasing innovative companies. Due diligence. Once an opportunity is spotted, it's time to look closer. Due diligence is the deep dive into the details. Think of it as a home inspection before you buy a house. Would you buy a home without checking if the foundation is solid? This step checks the company's financial health, operations, and legal standing. Here's what it involves: financial analysis, reviewing balance sheets and income statements to ensure transparency and profitability. Operational review, assessing business processes and management structure to see if they're robust and efficient. Legal checks, ensuring there are no hidden legal issues that could affect future earnings. Due diligence is crucial because no one wants a nasty surprise after making an investment. It's about gathering all the facts to make a well-informed decision. Negotiating and closing deals. So, you've decided the house is worth buying. Now, it's about agreeing on the price and signing on the dotted line. Negotiating and closing deals is where the art of conversation turns into a handshake and a contract. Here's how it unfolds. Negotiating terms. Both parties discuss the investment amount, the ownership percentage, and any other terms of the deal. It's a give and take, aiming for a win-win situation. Structuring the deal. This involves deciding how the investment will be financed. Will it be all cash, or will there be loans involved? Structuring is like setting up the game rules. Signing and sealing. Once both parties nod yes, they finalize the deal by signing agreements. It's the last step before officially becoming business partners. This phase requires clear communication, sharp negotiation skills, and a focus on ensuring the deal benefits everyone involved. Mastering the private equity investment process is essential for any firm looking to boost their investment portfolio. With a clear strategy, careful evaluation, and skillful negotiation, private equity firms aim to turn potential into profit. Risk and return in private equity. Private equity is like a roller coaster ride with ups and downs, and understanding the risks and rewards is crucial. You would never jump on a roller coaster without knowing what to expect, right? The same goes for investing. Let's break down what you need to know about the risks and potential returns of private equity investments. Understanding risks involved. Private equity investing isn't just about the potential for high returns, there are risks that come with it. Here are the main types you should keep your eyes on. Market risk. This is the risk of economic changes affecting your investment. If the economy takes a hit, so might your investment. Think of it like a stormy sea that can toss a small boat. Operational risk. This is about the business itself. Poor management or inefficient processes can lead to losses. Imagine running a restaurant. If your chef doesn't show up, your business could suffer. Financial risk. This involves how much debt a company has. If a company is too heavily in debt and can't meet its financial obligations, it could mean trouble for investors. It's like borrowing too much money and then struggling to pay it back. Recognizing these risks helps in making informed investment decisions. It's not about avoiding risks but managing them smartly. Return expectations from private equity. Private equity often promises higher returns compared to traditional investments. But what should you realistically expect? Average return rates. Private equity typically aims for annual returns between 10% and 15%. This is generally higher than what you might see in public stocks and bonds. However, these rates can fluctuate based on various factors. Factors affecting returns. Economic climate. Just like a farmer needs the right weather for crops to thrive, your returns depend on the economic environment. Company performance. Strong performance from the companies in your portfolio boosts your returns. A good company is like a well-oiled machine, efficient and productive. Exit strategy. When and how you sell your investment can impact your returns. A timely exit can maximize profits. Investors should weigh these potential returns against the risks. If you're okay with a bit of turbulence for the chance of a big reward, private equity might be your cup of tea. Consider whether the potential gains align with your financial goals and risk tolerance. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.